I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome to the show, Mike.
Oh, thanks for having me. I'm doing really good. How are you doing today?
We're doing great in Vancouver. We never had winter, and we have a glorious spring, 70 degrees. Lots of cherry blossoms. You can't complain.
Oh, that sounds wonderful.
The U.S. Fed made some noises today. Was it anything important?
Are you talking about the Federal Reserve today?
Yes.
Well, we've been seeing all kinds of stories back and forth about the Fed. Sometimes they talk like they're going to raise interest rates, and then they'll say, oh, we got to be really cautious. But the bottom line really is, for the past couple years, except for December. December was really interesting. When they raised rates one time, they really predicted that they were going to do it 4 times this year and seemed to be almost adamant about that. They created these projections and plots and graphics to go along with that. But despite that meeting, the story's completely changed from where we're talking now. And we've gone back into the consistent pattern that we've been in for years, really, and that is that the Federal Reserve will kind of basically say they're data dependent, they want to see what's going to happen in the future, and they're very kind of uncertain, but they predict that things will be okay anyway, but they have no clear picture of where interest rates are going. And out of that kind of environment, one week you'll see them make statements to the effect that they might raise rates, then another week they'll have some worrisome news they see in the economy or something and take it away. And the impression you get is this big debate is going on about what's happening in the economy, and they're looking for confirmation. And that's kind of been the story for years. However, the last Fed meeting, something really interesting happened. We didn't know about it until a week ago, and that's when the Federal Reserve released minutes of that meeting. This is the March meeting, actually, not the April meeting. But what those minutes showed was that the reason they didn't raise interest rates is because they didn't think the stock market rally that was going on would go on. They thought it could top out and we would go back down, and probably will, but they were doubtful the rally was real. And that's a shocking admission that the Federal Reserve is really looking more at what the stock market does than any of these pronouncements you see them deliver on the television set or you see in the media. So I think as long as the stock market, well, I thought coming into this year, as long as the S&P was above 2,000, they would be able to raise rates. But it seems even that isn't certain, isn't good enough. And they obviously don't seem to think we're going to stay above 2,000. If they did, then they'd be looking to raise rates soon.
The Fed did say one positive note was that wages are up.
Yeah, that's right. And historically, the Federal Reserve is supposed to raise rates and do a more tighter monetary policy when wages go up. That's just, I'm talking about for decades. That was really the final signal that they would do something, but it doesn't seem to be that it's going to be enough. And I still think they're really more looking at the financial markets. Now, when we had those last 2 meetings, they didn't say that in their public statements. Instead, they blamed their worries over the rest of the world, that China or Europe or wherever where we've seen financial gyrations, but in reality, it's our stock market that they're really looking at.
Well, of course, the stock market traditionally has been the engine that drives the economy, except it really hasn't been doing that the last 4 or 5 years. They're kind of feeding on themselves.
Well, the reason that is if you look at since 2012, and we've talked about this a couple times in the past year, what really drove buying in the stock market were corporate share purchases. The corporations buying the stocks back themselves. And last year, the individual investor actually took a little bit of money out of the stock market. They didn't put much in. They didn't put more into the market than they took out. And so there's some foreign selling too. And most of the buying, therefore, was generated by these corporate share buybacks. The problem is these share buybacks are generated by corporations issuing junk bond debt, going deeper into debt, and they're doing more share buybacks than real investments and trying to grow their businesses or expand sales or do anything that's going to have a long-term impact on the health of their companies. So it's really short-term stuff that they've been doing and some companies, I think, are going to end up in a very dangerous financial position as a result. There's companies such as Sirius Radio that I'm actually betting against it. Their shares, but they have something like 5 times the amount of money they make in revenue being spent on share buybacks, which I think is really crazy.
Of course, share buybacks are usually to boost the company shares to a point where the CEO gets a bonus, but what about the success of the company?
Well, that's exactly right, and that's what the CEOs do. They have stock options, and they'll, use the options to buy stocks really cheap that they've elevated at high prices, use their share buybacks, then they'll dump them. And it's a big question. What's the long-term viability of some of these companies? And some companies will be fine, but others not so much. And you can look and just see what's going on in the balance sheets of your favorite stocks. If you go to something as simple as Yahoo Finance, you can put the stock symbol in and click balance sheet on the left sidebar and see what they've done over the past couple of years and see, is your company that you like, is it growing in earnings or doing investments in their own businesses, or are they just going into debt to do share buybacks? And if it's the latter, I really want to be a long-term investor. I mean, that has nothing to do with what a stock may do tomorrow or the next hour or what a trading robot will decide to do from second to second. But I think it makes for a very poor long-term investment for people to make in stocks that are companies doing these sort of things.
You said there's a setup for gold. What is the setup?
Oh, yeah, that's actually, to me, the most exciting thing going on in the financial markets. It's and it's not necessarily the price of gold itself, which I am bullish on. I think we started a new bull market, and we're very early in it. But it's the mining stocks are doing something absolutely incredible that is the most profitable pattern to buy something that I know of, period. And it only comes around really every couple of years in a market or a sector, which the mining stocks are a sector. What the pattern is, I call it the twofold formula. And it only happens at the very beginning of a bull market. And it consists of two things. The first thing is stocks, or a sector, we'll use the GDX ETF for the mining stocks, that goes up off of a bottom 50%, 80%, sometimes even 100%. And a lot of the mining stocks did rally from January over 100%. The GDX went up over 70%. So it's a huge rally you get in a very short amount of time. But after the rally, this is the real critical thing, the rally consists of a move through the 200-day moving average after a long period below it. But the real critical thing is after the rally takes place, you get a period of sideways consolidation from anywhere to 4 to 8 weeks. During that time, everyone is kind of like watching what's happening. There's people saying, wow, this is just a baloney rally and it's going to come back down and make new lows, or you have this giant pullback, but that doesn't happen. And instead, you get a breakout. Now, that's the first technical part of the pattern, and typically what happens once it's complete is you get a similar move up as you just had to start this. So if a stock doubles and then consolidates for 4 to 8 weeks and breaks out again, it typically doubles a second time. So that makes for a great low-risk entry point where you actually stand to make a really big gain in what you're buying. So a lot of people right now are very excited in the United States as they're speaking about the S&P 500 because it's rallied for several weeks, and it hasn't made a new high, but people think it's getting close to it, and they're getting so excited about that. But the problem is if you break the high, you really don't have much upside. You may make 1 or 2%, maybe just from here. But with this sort of setup you see in gold stocks, you can, potentially make double in the right stocks in a very short amount of time when they break out. And some of them already broke out last week. They're already up huge, but I think they're just starting to move. KGC, I don't own it, but it's one that's gone up a lot just in the past couple of days. And I think these things are just starting another move like they did in January. Now, the second part of this pattern, which is I call it the twofold formula because it consists of two parts, is fundamentals. And that's to pick out the best stocks that have the best growth potential but are still at a very cheap price. And again, this is something that really only lines up at the start of bull markets. People, when they talk about fundamentals, they really have fuzzy thinking about what they're talking about. For example, if you turn on your CNBC television program, you'll hear people recommend stocks. They'll say something like, oh, I've got a good product coming out, or I like this company because they've got nice shoes, or I like Apple because it has phones and they're growing and so forth. And if they talk about anything specific using numbers, they'll talk about sales forecasts, earnings estimates, and big percentage gains. But it's not really clear what the strategy is there of when you buy or sell something. It just seems to amount to, well, I like the story, and these headlines are fun, and I'm going to chase these headlines. Well, that's not real fundamental investing. It's people who think they're doing fundamental investing, but they don't really have any strategy. With the pattern and setup I'm talking about, what you do is you look for companies that have high earnings growth for the next couple of years in a sector, but at the same time, the stocks are priced cheap on a valuation basis. So you get the best of both worlds of both growth and value investing. And the way you can look at that is to find stocks that have something called a low price to earnings growth ratio, the PEG ratio, and it measures the estimated annual earnings growth for the next 5 years divided by price. And 1 is typically considered fair value, and 0.5 is considered super, super cheap. And that's the investing strategy that John Templeton used to pick out stocks. It's popularized in the book One Up on Wall Street. It's a book written in the 1980s. But the problem is for American investors, when a stock market goes up for a very long time, you just simply can't find stocks with cheap valuations, not in the United States stock market, generally speaking. So you can't use the strategy, even though this is actually the best way to buy stocks on a fundamental basis. But it's appearing in the gold mining space because these stocks are starting a new bull market. They didn't go up for years. They fell for years. So you have cheap valuations, and the right stocks have high earnings growth potential, and then you got this wonderful technical two-step consolidation pattern, going on. So this is like the most fantastic setup I know of to buy stocks. And here it is appearing. It won't last, probably for a couple months, but, you have to look for the stocks on an individual basis. And once the pattern's complete, I don't know where it'll appear in anything for a very long time.
We'll have more with Mike Swanson right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band coming to Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Mike Swanson. Mike, how big of an impact will it have on the economy of states that have passed anti-gay, lesbian legislation like Mississippi and North Carolina?
Well, I don't know. I live right on the border of North Carolina, and this is news where I live. I get on my Facebook thing, and people are talking about it. And we saw, I think it was last week, Bruce Springsteen was going to go to North Carolina. Now he says he's boycotting because they made this law about the bathrooms you're speaking of. But I really don't see how it can have much of a long-term effect. I think it just generates some headlines here and there and gets a lot of people really stirred up thinking that, at least this is what I see on the internet, that their way of life is changing or going to be destroyed, and it scares lots of people, but it just seems kind of silly to me.
Well, Vancouver's Bryan Adams canceled a concert as well. And I saw Georgia did not enact the same legislation because Atlanta is, of course, corporate headquarters to a lot of corporations like Coca-Cola. And I think they were worried about possible boycotts.
Wow. Yeah, actually, Charlotte, North Carolina, I think PayPal made some announcement that they're not going to put some sort of operation in North Carolina, too.
500 jobs.
Yeah, so that's more meaningful than the singers, I think. But I don't know. It's hard for me to believe. I just kind of assume it's just a passing thing that'll go away, and that'll be that, but we'll see.
Peabody Energy has filed for bankruptcy. Is that a big deal in the oil patch?
Well, it's interesting. I think the bankruptcies are just starting. It's amazing. It's been 2 years, really, since oil topped out. That was in 2014. And last year, most of the oil companies just kept firm to their earnings estimates. They kept firm to their dividends and didn't want to say things were going to be bad for them, but now we're finally starting to see some blow-ups happen. A couple days ago, in fact, we saw Chesapeake Energy say that they're going to put their whole company up for collateral just to stay alive. And the key is it's been 2 years since the top, and I think this process is only now just starting, and it'll probably continue going forward. The mining stock space, had to go through something like this too. The mining stocks really topped out in 2011, but you didn't see huge write-downs and missed earnings estimates and bad news really hit the stocks until 2 years later, and then it took another couple years for them to go into a bull market. So I think this is just the start of something in the oil sector, and it can take quite some time before we see a huge turnaround there. Now, the last 2 times we had bear markets in oil was when oil peaked out in 2008, and it bottomed out in 2009. The oil stocks did of everything else, so that seemed like a very quick bear market. But if you go before that, we had one in the 90s, and you had a bottom in oil in 1999, but a new bull market didn't start until 2002. The mining stocks just had a rally and came back down, and it wasn't really until the whole United States stock market began a bull market that oil started one too. And then, of course, there are other very long recessions for oil in the 1980s, and also one around 1979 or 1980 that started then too. So these things take a long time. It takes a long time for a cycle to play out, and people get tempted to say, well, this is bad news, I'm going to try to buy it. But the bad news can go on for a very long time for the entire sector, and it's a slow process.
Panamanian officials have raided the offices of Mossack Fonseca, the law firm that had the leak with millions of files indicating massive tax evasion from around the planet. What kind of fallout is that going to have for a long time?
I really don't think it'll have much. I think these people will just find new ways to move their money around, and they'll just do that. I mean, if anything comes out of it, it'll be one or two headline cases where someone really gets in trouble, but beyond that, I wouldn't expect for much to happen. I mean, the reality is that massive money laundering goes on that we really have no idea of, and much of it's still kept secret. You look, I mean, it's 60 Minutes did a show recently about 9/11, and when we had in the United States an investigation in 9/11, they issued a big report on it, and there's 28 pages of the report that are classified. We're not allowed to know what they say, but congressmen and senators on the Intelligence Committee have suggested that what these pages have to do about is financing of the terrorist attack against the United States, and they hint that the financing, some of it at least, was done by some people in Saudi Arabia. Well, the point is, if this is all true, it's been kept secret from us for 15 years, and it's money secrets, being moved around, and that's just one example of who knows what's secret. I mean, we see these stories, and I read about it last week in the newspaper, but I don't really know. It's probably just a drop in the bucket, and it'll end up being more of a show than anything else.
Is it good news for the world economy that China's exports, after 9 months, have increased 11%? They were up 11% in March.
Yeah, I think that's a good little blip there. I like to see it continue. As you mentioned, we saw a little uptick in the wage growth in the United States too, but we're not really seeing the Chinese stock market respond to that news. I was just looking at it this morning, and the Chinese stock market hasn't gone anywhere for the past month. Of course, last year it had a big drop. All it did was bounce, and it hasn't continued to bounce for weeks. It's just kind of sitting there. So I kind of suspect it's just going to roll back over.
Well, instead of the stock market in China, I think they're investing their money in Vancouver real estate, buying shacks for $3 or $4 million.
Yeah, I think you're exactly right. I've heard stories of Chinese people buying companies in the United States even, and they've got a giant project they're doing in the Bahamas. They're building this huge casino down there. So I think that's what they're doing. They're doing infrastructure all over East Asia and in Africa and so forth. And the stock market really probably is just not even that important in a big scheme of things when it comes to the whole picture of China. But it's a sign that things did get overheated. That's probably the real reason their stock market did what it did. We're talking about the declines in the stock market, but the thing is that stock market went straight up for like 6 months into that peak of last year. I mean, it was a true bubble. If you look at the chart, it did what silver did in 2011. Silver prices doubled in a couple of months, and that was the top. So it's just this big speculative blow-off appears is the real story there, not like the end of the world in China or anything like that.
Mike, thank you very much for chatting with us.
Thank you. Great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet, Our YouTube channel is Talk Digital Network. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.